Well, good morning, and thank you for joining us today for our May coffee break. For those of you here with us for the first time, Treasury Strategies conducts monthly 20-minute coffee breaks to help keep you abreast of the hot topics and challenges in Treasury management today. As a benefit, everyone who's registered for the session will receive a copy of the presentation and a link to the recording in a day or two. Should you wish to ask any questions as we go through our presentation today, you'll find a question and answer box in the bottom right-hand corner of your screen. You'll key your questions there. We'll handle these offline once the coffee break concludes. Our session today is titled, Avoid Pricing Paralysis, Strategies for Long-Term Value. And while we're certainly going to be talking about pricing today, I think our point of view is that it really has to be thought of in the broader context of overall revenue management. We're going to be talking about why getting it right the first time is so critical in our current environment, what banks are doing today and why it really isn't working very well, and best practices and insights from Treasury Strategies' extensive experience with revenue management for banks of all sizes. My name is Jim Poteet, and I'm joined this morning by my colleague, Marika Christopher, and we are both principals in the Treasury Strategies Financial Services practice. So let's jump right in and get to our discussion. Why is pricing and revenue management so critical right now? So what we hear in all the discussions we have with our clients is the transaction banking leaders are really being charged with growing the business and being challenged to do so at double-digit figures, but unfortunately being forced to try to accomplish that in an extremely competitive and regulatory burdened environment that we find ourselves in. Low rates over the last several years have really leveled interest margin, and so the pressure is really on the fee side to try to grow the revenues because it can't be made up in spread any longer. And in the short run, really what we find is pricing is about the only way that you're going to have an opportunity to accomplish that. So as I said, you've got the balance of non-interest income and net interest margin due to the Basel III impacts. We see, again, as we talk to our clients, a pretty wide range of performance by the banks, but on the whole, the market is only producing low single-digit growth, and yet we consistently hear about the higher goals that each of our bank partners are trying to achieve. And so we feel like pricing is an attractive lever to help grow fees in this environment. The good news, perhaps, is that we have a burning platform for our executives today specifically to pricing, and so they have to deliver revenue and deliver profits. And so we have this top-down push as opposed to a bottom-up approach to pricing, which may give some more added incentive and benefit as we try to take the new pricing to the market. We'd also point out from a fee standpoint, as an industry, we sort of have a oligopoly structure, and so pricing ends up being a higher power tool and lever for us as a result. So on the surface, it might seem like a rather simple solution. Hey, just execute a pricing event, raise prices. But what are banks doing today that isn't working, Marika?
Well, Jim, there are a few pricing habits that stem back to the historical construct of the banking organization. Generally, banks have taken a very narrow view of pricing changes, a very limited incorporation of the overall product strategy and the overall organizational strategy into those pricing decisions. Pricing reviews were seen as a yearly event to gather maybe 1% to 3% lift, and the product groups would then wait another 12 months before reviewing those prices again. So let's review a few of the bad habits that some of our bank clients have been using when creating their pricing strategies. The first is treating all clients and products equally. Oftentimes we'll see there's no differentiation or connection between the services and their corresponding price and the deposit balances with those services. Secondarily, pricing of the services does not typically reflect the product continuum or the value that the service offers to the client. We see a couple of key themes here. For example, many banks do not take a rigorous approach into pricing out products that they no longer want their clients to use, keeping that same $5 price for that CD-ROM that a client would like sent to them monthly, even though there's reporting available through some other cost-effective channels. Other times, you may decide that a certain product should be a loss leader to drive adoption of that product. On the same note, some services do not even have a fee. We frequently find that our clients are missing service codes or are offering valuable services for free as products have been built up over time and not incorporated into their pricing strategy. Our second bad behavior is that many client and internal bank behaviors have become ingrained into our psyche. Exceptions and waivers are trained behaviors to both clients and our sales teams, particularly when they do not have an understanding of the comprehensive pricing and product strategy, and then are unable to communicate that to clients. We also see that many clients of ours struggle to turn the data gathered about client behaviors related to pricing into actual intelligence. Banks have a myriad of data to test price sensitivity, the pricing behaviors of clients, but don't have the structure then to translate those behaviors and findings into their pricing strategy. There's also a lack of confidence in the target fee lifts that some consulting firms are offering up. Is it 4% that we're going to gain, 12, 18%? Who should I believe? And while there's certainly opportunity to grow fee revenue quite a bit, if you try and target that 18% annually, you're going to drive all of your clients away. Annual growth of 12 to 18% from price lifts are unattainable and unsustainable for 99% of banks. It's more important, we found, to create a structured methodology and a realistic framework for your revenue program and make those increases stick in the long term. Finally, there's poor execution of pricing changes that can paralyze the organization and your growth agenda. Once you have a pricing strategy, this is the place where we see most banks fall down. Many banks will end up spending more time dealing with the aftermath of their pricing decisions than the other underlying problems themselves. You end up with clients that are upset, salespeople that are upset, and losing valuable clients because you executed the pricing strategy poorly. Sometimes getting the salespeople on board with pricing is harder than getting the clients on board. We hear some salespeople define their role as advocating on behalf of the client to the bank. This is not their job, and you need governance, metrics, and coaching to overcome this myth. The trick is not to just force new pricing onto sales, but to educate them on the bank's pricing power, market pricing, and the value of the service that you are providing to the customer. Salespeople can certainly add value by identifying key inputs into the pricing strategy, but there also needs to be balance and pressure for them to get outside of their comfort level and show the value that the bank brings to these clients. And so what does it mean if you implement a pricing strategy and not one client leaves? Well, there's two options. A, you executed on your pricing strategy perfectly, which is probably unlikely, or B, you didn't raise prices enough and you left money on the table. Switching costs are at an all-time high for companies, meaning that banks can price for value, increase their hard dollar fees, and clients still won't leave. This is even more true for companies who have complex structures and those who don't have the resources to manage a conversion to a new provider. Additionally, there's a decreasing supply of appropriate banking providers for certain types of business due to regulation and shifts in our target markets. For example, third-party processors, healthcare entities, complex legal entities, and this makes it even harder for these types of clients to leave you if you choose to serve them. This means more pricing power to you. So Jim, given all that banks are doing wrong with revenue management today, what can they be doing to get this right?
It's a good question, Marika, and banks can't just take out their Harry Potter wands and wave them around and instantly raise prices. That much we know. And it really, truly begins by making the investment to establish a comprehensive pricing and an overall revenue management strategy to get it right. So if we look at our picture of this little paper airplane here, you think of the wings as the tactics and the air around it as the strategy. Without the movement of the air creating the lift and thrust, that's what creates the opportunity for the plane to fly in the first place. So if you don't have that strategy, then all you have is a folded up piece of paper, not a really cool paper airplane. So we have to acknowledge that we just can't focus on the tactics of pricing, the wings. We've got to agree that success really comes through a comprehensive strategy and having that air to lift us up and get us going. So how do we start? I mean, you've got to have an objective around the strategy in the first place. How do I set my desired price position against my competitors? Am I at market, below, above, and why might I be in that position? And is it different for each product? And how long do I need to stay in that position? Am I going through some type of product enhancement or transformational shift that would cause me to be in one position or the other over the next 12 to 18 months? And really strategically making that decision as opposed to it just happening. How do I differentiate or align my pricing based on channel? How do I price for substitute products? You think of remote deposit capture when it came on board and what that meant to a traditional branch deposit, or now mobile deposits. How does that figure in? And how do you link and align that pricing by strategy to create the type of behavior and revenue lift that you need as an organization? Risk is a tremendous part of our business today in compliance. How do I price risk in? How do I price inflation and costs and the value-added aspects of my products? All of these things make up part of the content of the overall strategy, and they have to be answered before you just start going through your service codes and scratching it out and creating a new price point. There's a lot of talk and activity in the marketplace today relative to customer experience, and frankly, we think from a Treasury Strategies perspective that links to pricing as well as it does the service experience, the product experience they might have. And does your pricing really align the experience you want your clients to achieve? And how do you communicate that value of the solution and your bank, right? Marika talked about that a few moments ago. It's critical as you create your pricing strategy that you fit that in. The strategy and tactics also have to align, up and across the organization, bank-wide, around the different strategic and product goals that might exist. You can create significant confusion, both internally and externally, if you don't ensure that the connections are made up front relative to your pricing and what the overall strategies are with the organization. Needless to say, it's easy to just say, well, client switching costs are high, and therefore we can just raise prices because we're not going to be able to leave. And while you need to consider switching costs, we don't think that a just because we can pricing strategy is the right way. It's not a long-term way to create partnerships and a win-win strategy. And you want to treasure those relationships because they're very hard to cultivate, and switching costs for you as an organization are just as difficult as well too. So if all that isn't enough to swallow, right, there's still more to consider as you think through your strategy development. Understanding the market pricing at a portfolio and a deal level, those are different. What is the substitute a customer can get based on my solution set? Is it as good? Is it as cheap? How do I differentiate myself? It's hard to raise prices on a commodity relationship, and so you've really got to be able to understand, segment your clients, your portfolio, and your products in a way that allows you to identify those places that value is being created and charge for it specifically. We know that switching is difficult for clients, and that's why the portfolio pricing we see tends to be higher than the deal pricing, because on a deal-by-deal basis, you're trying to encourage that customer to move. But that being said, do you actually have a defined deal strategy versus just the willy-nilly salesperson reducing the price or waiving a fee just to win the deal, but not really having thought through long-term what the strategy is? And then again, the customer value, really being able to identify and point to the value that you're providing to your client, the quality of the execution of your transaction process, the share of mind and the advisory relationship that you have with your client, what credit position you hold, the efficiencies and business intelligence you bring to your clients through various solutions. All those things have to be considered, both from your perspective as well as your client's perspective, to ensure that that strategy is really holistic. So we take a deep breath, realizing how much work it really takes to create a strategy, and it's a significant undertaking. But there's also, once you do the strategy, there are the tactical steps that have to come next. We would submit that you routinely need to be looking to improve across all your pricing dimensions, From a structural standpoint, the price points themselves, the combinations, the packages, are you missing price points? In the pricing work that we do with our bank partners, we typically find the lack of a defined structure has greatly contributed to the pricing struggles they're experiencing. And it's not that hard to create a structure, but many folks really haven't thought through that from end to end. The price points themselves, what will the prices be, and then the governance around exceptions and waivers and how you execute tactically the pricing event and manage it out in the field. Estimating the impacts of the new pricing to help further refine the strategy. It's not enough just to create and determine what the new prices are going to be, but you've really got to go through and model that out within your portfolio and at the client level to understand explicitly how that price change is going to manifest itself out into what clients see and how your portfolio reacts, and estimating those switching costs and what's the market supply for that type of client, what are the potential adverse impacts that could happen, and taking all of that information to go back to your strategy and refine it and develop mitigating steps to ensure that you can execute the strategy, you can execute the pricing event, and it does stick and last long term. And then you have to operationalize it, right? Roles and responsibility, who's doing what, how do you communicate internally and externally, articulating the value, the governance behind the process, and making sure that the strategy stays successful. And expecting to have to overcome some objections from your clients. And think about, can you shift the share of wallet, solution mix, move balances into ECR-related accounts to help offset the fees. So, and again, it's not enough to set the strategy and think about executing it, but then how do you make it stick long term? So Marika, how have banks really started to approach pricing and revenue management?
Thanks, Jim. Well, we've certainly talked a lot about pricing in this morning's coffee break. We've talked about how banks have historically approached pricing and revenue management, what banks are struggling with today around pricing, and how that affects the overall client experience and the perception of value delivered by the bank. And we've talked about how to approach pricing in a more strategic manner to meet your fee revenue goals. And Treasury Strategies brings a very differentiated perspective in developing a pricing strategy for our bank clients. Unlike the other consulting firms, Treasury Strategies brings a 360-degree view of the market. We work with corporations, your end users, and we understand how they behave and what they look for when they're choosing a bank provider. And we've worked with a multitude of banks of many sizes. We have best practices on how to create a valuable and long-standing pricing strategy that serves both you and your clients. We approach our pricing partnerships in the following way over the past several decades of doing this pricing work. First are the inputs or the assessment. We use a couple of inputs to drive the pricing decisions or changes. Our proprietary pricing database lets us fine-tune price changes based on scale dynamics and how to adjust pricing from a deal and portfolio perspective, as Jim talked about earlier. We also incorporate our understanding of customer switching costs and their price sensitivity based on target market or the types of products that they're using. And finally, we use customer value dynamics to account for their interpretation of risk and differentiated value from the bank. The second piece here in the middle is our analysis or the model. We look to model the gross impacts of the pricing changes from piece one to further refine the strategy and build out the roadmap. We ask a couple of questions during this process. What range of potential increases do we feel comfortable with? Are we confident enough in the inputs to execute on the strategy? How does our pricing align with our organizational strategy and vision of who we want to be when we grow up? And once we have that target revenue lift percentage, which portion is allocated to each business unit and why? This final piece here on the right is where Treasury Strategies provides executional support. As I mentioned earlier, this is a place where many banks can fall down after completing step 1 and 2. We assist you in helping to communicate the pricing changes out to your staff, not only sales, but support and others, and help manage the governance process of those pricing changes. We assist in the execution strategy to ensure that sales has the tools and the confidence to convey the value that the bank provides to the market through these pricing changes. And we assist our clients in monitoring their overall price strategy and helping to adjust it over time. We'd like to thank everyone for your attendance at Treasury Strategies Coffee Break, Avoiding Pricing Paralysis, and we look forward to speaking with you about how we can partner to help you get this right the first time. Our next coffee break will be on Thursday, June 18th, same time, same place. So have a great Thursday, and we hope you enjoyed your coffee with us.